The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stock market goes down, the VIX goes up, and everyone keeps piling into the dollar and gold. Happy New Year from Studio 2 at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Alex Steele. Do you have a resolution?
I don't have one, but I do want to ask who that was at the start of the show introducing us. Have you met her?
No, I have not. My resolution is you got this. I think we should all have that resolution for this year. So the resolution for the market is we're continuing the downtrend that we saw in that non-Santa Claus rally. The S&P having a reversal Thursday here, now down by 0.6% after being up almost a full 1%. You have the Mag 7 stocks also down by about 1.4%, again being dragged down by the likes of Tesla, and that's weighing on the NASDAQ. And the Russell mid-caps also not to be left out. They're rolling over as well, Romaine, and the VIX remaining elevated.
Yeah, an interesting open here to the new year. A lot of folks really starting to reassess that bull market. That's been going on for weeks, if you will. Remember, this is a bull market that sent the S&P 500 up 50% over the last 2 years. And now a lot of questions here about whether we'll continue to see that. Remember, a big part of the rally was multiple expansion. A big part of that rally, quite frankly, it was narrow, a crowded trade in big tech. Investors chasing after companies with the most cash flow. But that's a trade that is now thinned out as strategists forecast significant deceleration in earnings growth.
S&P 500 earnings have actually only grown at about 7 to 8%. And yet the forecast over the next 2 years is that we're going to triple that growth rate and increase earnings per share for the index about 25 to 26%. And so I think folks are starting to realize that 2025, when it comes to earnings, is a show me year.
And Lisa Shallett's show me sentiment echoed by Goldman's David Kostin, who notes that roughly 33% of the earnings growth, 33% earnings growth that we saw for the Mag 7 last year was 30 percentage points higher than for the remaining 493 companies in the S&P. That excess earnings rate poised to narrow, according to him, which might be bad for the big tech trade, but potentially good for an everything else type of rally. Meanwhile, the upward price pressures that we see for soft commodities and metals in the last year extending here into 2025, supply constraints that drove coffee and cocoa to a record high, that hasn't abated. Neither has the dismal European harvest of food crops like wheat. That's bolstering prices there. And I know it's just one day, Alex, but how much can today's price action actually tell us about what the remaining days of the year hold for us?
50% accuracy. How about that? You like that? 50-50 shot. This is how we end the year. So this is a great chart that came to us from MLive right here on the Bloomberg, and it showed that 50% of the time, the first day of trading, the rest of the S&P moved in tandem throughout the year, but just 50% of the time. Now about 33%, it rose in tandem, and 17% it dropped in tandem. So the takeaway to this is that it actually doesn't really matter. There is that old age saying that on the first day, where goes the first day goes the rest of the year. This shows that that's not entirely true. But, Romaine, if you take a look at the last 5 days, it's not been pretty in an era where you're supposed to have that kind of Santa Claus rally.
Yeah, absolutely. And let's not forget how actually 2024 started with stocks on the back foot for the first few trading days of the year. And of course, that changed dramatically over the months that follow. Dennis DeBusschere joins us right now, our first guest here on the first show of the new year, president and chief market strategist at 22V Research. And let's start off with an extension or potential extension of that rally. Dennis, is history on the side of investors right now?
Well, it is if the earnings come through. Right. So there's 2 points that I think we need to make and that we're really focused right now. Like, if you're going to have the earnings growth anywhere near expectations, you shouldn't really be expecting a down market. That's point number one. Right. You'd need to see some tightening of financial conditions. It is very easy to see a correction, though. And this is something we've been harping on when we're talking to clients, is that broad market conditions, and I define that as, valuations in equities, credit spreads, the steepening of the yield curve that we saw 94th percentile month-on-month move in December. Those broad market conditions are so far away from anything recession or recession risk-like that you can have a pretty significant correction across the board with nothing changing, right? Just a slight change in the risk outlook could change risk assets pretty significantly to start the year. And, that's totally a possibility. But if the fundamentals are going to hold and that earnings growth is going to come through, it's going to be very difficult to short the market and make money as long as the economic expansion continues.
On that point, though, will this be about those other 493 stocks, and for that matter, the other 1,000+ stocks or so that we tend to care about outside of just the Magnificent Seven and big tech? When we talk about a narrowing of that earnings gap, that's big tech coming down, but the rest of those companies, at least based on the forecast from some banks out there, are going to come up.
Yeah, no, and I think you have the case right now, and actually really right now, to be long the rest of the market or the others relative to the mega cap names. So when you look internally at the market right now, just as an FYI, it's oversold internally. It's not oversold, obviously, at the headline level, which we hardly had a correction, but like 20% of S&P names are trading above their 50-day moving average. Okay, and you're absolutely right that there is going to be a compression in earnings spread between the megas and the rest. That is absolutely forecasted. Here's the problem with everything I just said, and I probably said this on this show before. I'm going to have tattooed on my forehead, my chest, my back, never short mega, because they always seem to outperform. Their earnings seem to consistently be revised higher. This might be the year that it changes. That's clearly forecasted. We're long the rest of the index, but I don't want to paint a picture of being negative on them until they show some sign of actually missing earnings.
Don't get it on your forehead. I feel like that just sends the wrong. That's just a weird starter to cocktail party. So, okay,
it is.
I hear what you're saying. Then, what areas of the market are oversold that you do think has some earnings potential pickup?
Yeah, I mean the one that's really interesting right now is probably small caps, given the decline you saw in December. We got out of small caps in early December. Look a little interesting right now because on a rate of change basis, if you're thinking about like where earnings were last year, negative 10%, to where they're going to be next year, which would be plus in the 8 to 10% range, that's a significant change in earnings over the course of the year, delta kind of year on year. So I think that's an area you want to start looking at again, mostly on the more cyclical sides of it. And the same goes for something like energy. Energy had a terrible year for earnings. You should see some positive, not in level terms, it's not totally attractive, but from a rate of change point of view, energy seems a little bit interesting right now, and does get to an overall point. If you look at what happened last year, the things that outperformed had the most earnings growth on a relative basis. So that change in energy, as an example, is actually pretty interesting right now. Please don't take this as short tech, right? It does not have to be like one or the other, but that's where it looks pretty interesting right now.
Do you think that you need Fed cuts to continue more than once or twice for earnings of the cyclicals and other areas to hold up also?
Well, theoretically, for earnings to hold up, no cuts would be better, right? Because that would mean inflation stubbornly higher. And inflation is the act of companies passing on those costs. Now, what you do get if you have inflation stuck at too high of a level, yes, your earnings will actually be a lot stronger than what is forecasted right now. But you get multiple compression because, maybe the Fed has to tighten financial conditions, which is actually something I'm worried about. But I would say, to your initial question, I think for a really big rally in the market, you probably need the Fed to cut this year. You need to see that extension of the disinflationary boom that we saw in 2023 and 2024. Very strong growth. Inflation came down. It doesn't seem like that's in the cards for now. We could be, wrong depending on the inflation data comes out. So you're probably more biased to less Fed cuts, which is okay for earnings, but it does give you a multiple problem.
I am curious. So then, Dennis, when we talk about sort of the fundamentals and ideally they hold up both on the corporate side as well as the economic side, what are sort of the big risks, the big exogenous risk, if you will, that investors should at least keep a very close eye on? Where is that going to come from?
Yeah, the more we think about it, I think I don't know if this is exogenous, but I'll answer it as what we think is a very obvious risk that is not necessarily a base case is the manufacturing and housing side of the economy is not weak enough to slow all overall growth. Like consumer spending is so strong right now, certainly on the service side. And if anybody was at a hotel over this break, you know what I'm saying. But it's so strong that you actually need pretty weak manufacturing and housing data to keep demand growth at a level that does not create potentially a lot more inflation. So you take a PMI today, service sector PMI, coming in a little bit unexpected. New orders up, right? Expectations up. What happens if the housing data is stable? It is quite possible that you might actually need much higher interest rates to cause an employment rollover in those interest rate sensitivities. So not just weakness in manufacturing, and again, it's actually getting a little bit stronger here, but you might need to see interest rates so high, and we could pick whatever that number is. I don't know, maybe it's 5%, no idea. that actually impacts employment in interest rate sectors because the consumer is so strong. And if you were to see that, that would certainly throw a wrench in things. I think you'd get a pretty significant market correction. I think it's within the realm of possibility.
Yeah.
It's not a base case, but certainly in the realm of possibility.
All right, well, something to chew on here. A great start to the show, a great start to the new year. Dennis, we'll talk to you again soon. Dennis DeBusschere, President and Chief Market Strategist with 22V Research, as we continue to kick you off to the closing bells. A closer look at Biogen, one of the worst performing pharmaceutical stocks last year, not starting the year off any better. A price target cut over at Piper Sandler. Why the analyst sees a major uphill battle for one of the company's biggest franchises.
Plus, with the new presidency mere weeks away, we're going to look into how trade relations will differ for the U.S., including right here on North American soil, with Eswar Prasad, Tolani, Senior Professor of Trade Policy with Cornell University and Senior Fellow at the Brookings Institute.
And we continue to focus here on the best performing sectors of last year and, well, whether they continue that in 2025. Airlines, travel had a phenomenal 2024. We're going to talk to the head of the Points Guy about what they're expecting when it comes to the world of travel.
Notes for me.
Absolutely.
Yeah,
I
okay.
will. Sir, I'll be taking notes for myself, too. All that more coming up here on The Close. This is Bloomberg.
Shares of Alphabet off the lows of the day. This is after JMP Securities downgraded the tech giant to market perform on the possible impact of antitrust penalties on Google revenue streams. Joining us now is Dave Lee, opinion columnist with Bloomberg News. And all of this raises the question for me, does big government have the possibility of denting big tech this year?
That's a good question. I mean, I think one of the things we're going to see this year is some of the antitrust stuff come to a head, and we're going to see what the punishments might be doled out for companies, particularly Google. You know, they're arguing that the government's idea of breaking out Chrome and harming other parts of his business would be going too far. They want lesser penalties. But if what the government wants does happen, then that could be major parts of Google's revenue, as the note was warning there, just sort of being taken away from the company. So it's definitely a big concern.
When I think about the AI trade, obviously the regulatory aspect of it certainly is a big risk. But the other risk of it, and maybe this is just my own bias in using some of this stuff, is it's not good. And I am curious. No, I really mean that. And it's like,
good point.
Like when you use some of this stuff, and this is more the consumer-facing stuff, and I know there's a whole segment of AI kind of beyond the realm of normal consumers. It probably is a lot better. But at least what we're getting, I am curious whether we could see a slowdown in adoption, a slowdown in people using it because they're not necessarily getting the results that they think is required.
I think this is a big problem, and particularly for a company like Google, right?
Yeah.
Because when ChatGPT came out, it amazed everybody. People started using it, go, wow, I can't believe this can do what it can.
Yeah, I was the same way.
And it's almost perfect, right?
Almost.
And it's still as almost perfect now as it was then. I mean, it has got better in several different ways, but for all intents and purposes, it's still, almost feels gimmicky to many, many consumers. And so when Google or another company starts serving up, say, search results that are kind of okay, often get it wrong, sometimes say, put glue in pizza or this kind of stuff, it really turns people off.
And some of them are really wrong.
Some of them are really wrong.
As soon as you read them, you're like, this can't be right. and then you know what I'll do? I'll then Google the actual correct answer, which will actually have a discrepancy against what they're feeding me through the AI thing, which I don't understand.
Although I was at a dinner party and random people were lawyers were talking about how ChatGPT makes their emails better and how much they love it. So for everyone you can find something else.
Everyone loves it. Who?
Yes, the lawyers. The lawyers love it.
Oh, okay, but not the people who they're sending the emails to.
Oh, no, the lawyers love it.
I don't think I've ever gotten an email from a lawyer that I loved. It's either I'm in trouble or I owe them money, one or the other.
I don't know about the actual person who got the email, but the lawyers really liked it. But it does give the idea of the AI pushback, right? And then you have a big tech potential pushback, and then we have this TikTok question, right? And do we see sort of a social media pushback also?
Well, TikTok, obviously, they're facing the ban that could come into force on January 19th, unless the Supreme Court steps in, and that hearing is on January 10th. But I think even sort of broader than just TikTok, I think, social media is going to have a very interesting year this year, because as part of that effort to make everybody use AI, you may have noticed that when you look on Facebook now, a lot of the stuff you're seeing that the algorithm's sort of sending to you is just the AI slop, it's become known, right? It's just this sort of, it's not true, it's exaggerated, there's crazy pictures that couldn't possibly be real, and people commenting going, this is AI, this is rubbish. And I think what we might start to see is where we've kind of got into this habit of scrolling through.
Yeah.
I think even more now, people are starting to go, well, this isn't, not only is this sort of just capturing my attention, but it's not even real. And so why should I do that?
And what's interesting, too, is I saw there was a story a few days ago how Meta's actually leaning further into this, the idea that they're going to allow more, I guess, bots, if you will, for lack of a better term. And they actually think that's a good thing. That also comes against the backdrop of one of their main mouthpieces to regulators, Nick Clegg, departing and basically replacing him with someone else. I don't know if this person is going to be better. Is there a reason why Nick Clegg is leaving?
Well, Joel Kaplan, the man that's replacing him, has been seen as the sort of Republican guy within Meta. He's been with the company since 2011, used to work for George W. Bush, and he has been the voice of the company sort of leaning against what you imagine as a backdrop of sort of more liberal Californians, sort of leaning conversations about policy more towards the right as a way of sort of appeasing, or some would say being more fair to certain viewpoints. The fact he's now in charge, I think just or will be in charge of policy, I think just reflects just the new political reality, right? You've got these companies, we've seen the CEOs going to Mar-a-Lago for dinner, we've seen them donating millions of dollars to Donald Trump's inauguration. The idea that Silicon Valley would be an adversary to Trump is now, that was the first term, ineffective in the first term. Now it's more about, okay, where do we find ways to work with Trump in various degrees? Yeah,
the only problem is now it may be the Trump administration might be the adversary for the tech industry, given some of the rhetoric that we had on the campaign trail.
Well, absolutely.
Interesting to see Dave Lee, one of our best columnists here at Bloomberg Opinion, a great write-up over just a couple days ago here about what 2025 has in store for AI and big tech. We're going to focus on what's going on in big pharma. When we come back, a closer look at Biogen. The shares under pressure today after Piper Sandler, well, taking a somewhat negative view. We're going to talk to the analysts behind that cut in recommendation coming up after the break. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls. These are the big movers on the back of analyst recommendations. And we're going to start off today with Uber. JMP Securities hitting the brakes on the company, downgrading the ride-sharing service to market perform. The firm viewing 2025 as a year of ride-share industry transitions to autonomous vehicles, saying they offer consumers a better experience. The analyst notes that Uber's valuation likely to be capped until the company better addresses that transition. Nevertheless, Uber shares having their best day since October. Next in line, Topgolf, Callaway Brands, Jefferies upgrading the stock to a buy. The analyst noting that the stock seems to be oversold at a time when the golf market is reaching new levels of popularity. Setting the price target at $13, up from 11 at $13. That implies a 65% upsized move. The shares up 12%, best day since February. And finally, let's take a look at Biogen. Piper Sandler cutting its recommendation to neutral. Some concerns out there about a, quote, lengthy transition period for the biotech company to some of its new products. The analyst believes that the company's build out of its Alzheimer's disease franchise and immunology-focused R&D are ways away from bearing fruit. More challenges in the years ahead. Shares down fractionally, or just down about 1.3% on the day, and those are some of our top calls. Let's talk to the analyst behind that call because he joins us right now. David Amsellem, a senior research analyst of biotechnology at Piper Sandler. David, all right, let's start with it. Biogen did not have a good year last year. I think shares are down like 40-something% or maybe more than that. There's been a lot of talk about this Alzheimer's franchise, and we're sort of well aware of all the issues there. I thought the research and development stuff on the immunology was supposed to kind of be the salve, or at least a bridge between one thing and another. Is that not enough to kind of keep this company going, the stock going, I should say?
Yeah, I think the problem for the immunology business isn't so much what's in the pipeline, but the fact that it is a ways away from actually reaching commercialization. There are actually some fairly interesting assets that are in mid to latter stages of development in the immunology pipeline. And the company, to be fair, has made some good investments. They have one biologic, for instance, that had phase 3 data for lupus that was successful, and data were presented earlier in 2004. But they have to run an additional phase 3 trial, and lupus is a difficult space in and of itself. And that second trial is not going to read out till 2027 or later. And so by the time that drug, and that's just one drug in the immunology pipeline, reaches the market, you're looking at 2029, 2030. So you're talking about a long road to a business that can then be positioned for stability and potentially growth. In the next 4 to 5 years, that growth is just not there. And I think that's the challenge with Biogen at present.
David, how long do you think that transition period realistically lasts, and how do you price a stock for that?
Yeah, I mean, so you have an Alzheimer's business that is kind of in the early innings of commercialization, and you have a drug, it's called Leqembi, where we've essentially questioned the risk-benefit profile. So you've got a product that I think has some flaws, and in and of itself is not going to be transformational to the company. Beyond that, there are other pipeline shots on goal focused on Alzheimer's. But again, it's a bit of a ways off till we get data milestones. And so that's one part of the challenge. The other part of the challenge is the base business. So looking at the base business, about 60% of the top line thereabouts is exposed to what is a portfolio of multiple sclerosis drugs. All of those drugs are facing losses of exclusivities, competitive headwinds, and so that's a lot of fires to put out. So you might have some interesting R&D, as I talked about with the immunology business. You might have some interesting R&D even in the Alzheimer's business, our concerns notwithstanding. But you've got a base business that really has a lot of exposure to assets that are in decline. And you're essentially, if you're Biogen, you have to run faster and faster just to stay in place. That's a very, very difficult challenge for any biopharmaceutical company.
Yeah. No doubt. I mean, for any company, really. But yeah, David, thank you very much. Really appreciate it, David. Amsellem joining us, Senior Research Analyst at Biotechnology at Piper Sandler. Thanks very much and Happy New Year. The stock, though, already down 43% within the last year. All right, coming up, we're going to discuss one of the biggest risks for this year, and that's the potential economic impact of one of President Trump's key campaign proposals, and that is tariffs. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
Happy New Year. I'm Alex Steele. We're off the lows, but still, it doesn't look like a very pretty day to start the new year for the equity market.
And you kind of pointed this out at the top of the show, too. I mean, the first day of the year, trading day of the year, not always reflective of what we get. And we should point out, too, this is a holiday shortened week. Maybe the price action shouldn't be believed, because I think we're the only two people who decided to come back to work.
I almost forgot to come to work, so there is that. Yeah,
I lost track of what day it was.
Totally. And also, I think the question then becomes all the sequencing we're going to get from a President Trump administration and sort of when that winds up affecting equity markets, right? You have tax cuts versus tariffs, right? You have immigration versus deregulation. Like, what comes first could also dictate that as well.
And I think the market might be waiting a little bit. Obviously, the inauguration here in the United States isn't until January 20th, and we have to kind of see whether he makes good on all those promises or whether it was just all talk.
Yeah, so let's get a little bit into that, because Bloomberg Economics crunched the numbers on what would happen to GDP in different countries based on whether or not all partners retaliated in an event of a trade war or only if China retaliates. And you can see Mexico getting hit the hardest right after Canada, with GDP wiped out by about 2%. The U.S. Comes next with about 1.5% negative to GDP. And the question becomes, we talk all about China and what it means for Europe, but the impact on the rest rest of North America could be huge, particularly for any sort of goods coming in from China through Mexico and Canada. So joining us now to discuss is Eswar Prasad, Tolani Senior Professor at Trade Policy at Cornell University and Senior Fellow at New Century Chair International Economics at the Brookings Institution. It's great to get your perspective. Thank you for joining us. Happy New Year. What's your base case for trade wars this year?
So Trump has gotten increasingly specific about the amount of tariffs he's going to levy, the countries that he's going to levy it on right off the bat. So I suspect this is not all bluster. Now, for the rest of the world, I think this could be seen as a bit of a bargaining stance. And the reality that is quite different from the first Trump administration is that the U.S. is on a very strong footing because the economy here has been doing remarkably well over the last few years in the post-COVID period. But in addition, the rest of the world is really floundering in terms of economics performance. If you look at China, Europe, including powerhouses like Germany, Japan, and even India, which was roaring along until recently, none of these countries can really withstand the effects of a significant increase in trade sanctions around the world. So they're going to be on the back foot. So it's going to be a very interesting bargaining game. But my bet is that we're going to see at least a small increase in tariffs, perhaps some symbolic amounts, but especially targeted towards China. And what the world does to retaliate, I think, is the key question at hand.
Exactly. And if we just focus in on North America for a moment, I can make an argument that, you know what, it's legit, because if you have stuff coming from China through Mexico and Canada, you're not going to want to get that into the U.S. versus the other side, which is you're really going to hurt your partners in trading within North America. What do you think the downside potential is here for that?
Now, for the U.S., there are some significant downsides. The imposition of tariffs generally ends up with customers paying a significant portion of those tariffs. So that could, along with the reduction in immigration flows, lead to an increase in inflation in the U.S. On the other hand, you could have a stronger dollar resulting from the imposition of tariffs, which will at least partially offset the increase in prices. But the bigger concern really is going to be about the disruption in global trade. And here, too, there are some very important differences. You know, in the previous Trump administration, there was this notion of the U.S. imposing tariffs not just on rivals like China, but even on traditional allies, including Canada, Mexico, and Europe. And we are seeing some rumblings of that as well. In the past, China and these other countries could perhaps take on the U.S. together. But right now, China's economy is not doing very well. And whatever growth they're getting is really coming from the production side rather than the consumption side. So the rest of the world is very concerned about becoming the dumping ground for exports from China, which it really needs in order to sustain growth. So there is a fracturing of the potential alliances among other countries, which again puts the U.S. in a strong position. But certainly disruption in supply chains and in production is going to be a cost that U.S. manufacturers and manufacturers around the world are going to have to bear.
Well, some of those governments, though, the ones that have to deal with China, and for that matter, the ones that have to deal with the U.S., is there any sense here that they will be able to find some sort of common ground between the two? Meaning, are they going to have to choose between a relationship with the U.S. versus a relationship with China? Or is there a way that they can sort of thread that needle and appease both nations?
That's a very complicated issue for many countries that are stuck in the middle. For some countries like India, it's somewhat easier because they're not that reliant on exports, and they could benefit from this geopolitical realignment, which shifts foreign direct investment flows to India and away from China. But the reality is that moving supply chains away from China to other countries is going to be very difficult, especially in the very short run. But at the margin, we are beginning to see changes. Now, a couple of the other things that the Trump administration is likely to do is to shut down the ability of China to reroute its exports through countries like Vietnam and Mexico, which have benefited actually from investment flows from China in order to undertake that rerouting. So those channels are going to be shut off as well. Yeah. So I think it's going to be difficult for many of these countries caught in the middle.
Well, Eswar, I'm glad you brought that up here, because whenever we talk about tariffs, we always sort of look at it from that blunt instrument aspect of it and the idea that it's just some blanket percentage that they put on goods. But there are a lot of areas that the Trump administration could exploit to, I guess, create a little bit more pain for some of those importers. And the idea that doing what you just did, which is, like I said, closing out some of those loopholes, but even certain things like kind of this obscure, postal rule that allows, companies like Temu and others to kind of ship kind of lower price goods, if you will, to the U.S. at basically no cost, or at least marginal cost. That's something that could be relatively quickly closed. I think he still has to go through Congress, but it is something that he could do relatively easy.
That's exactly right. I think even if he doesn't raise tariffs, closing many of these loopholes will significantly affect China's ability to reroute trade through other countries into the U.S. And that's going to hurt countries like Mexico and Vietnam, which have recently been benefiting from this trade diversion. Now, there are many countries that have very strong relationships with the U.S. and with China and would like to maintain them. But I think at the moment, one of the key factors driving the dynamic in this relationship is that it is the U.S. consumer that is powering growth in the world economy. Chinese consumers are really not stepping up to the plate. So you have substantial excess capacity building up in China. So I think much of the world is much warier about China using them as dumping grounds for its exports than they are about U.S. tariffs. But certainly for countries in the middle, they're getting pinched from both sides, and it's going to be a very complicated situation, not just in the short term, but in the years to come.
Right, which also makes it different from back in 2018 when it was a different consumer and a different Fed hiking cycle versus cutting, for example. Eswar, when you take a look at the profound effects of this, the whole point is to nearshore stuff or to bring industry home to the U.S. Is this all going to work?
It's going to happen in the long term, and we are seeing those changes already. Like I mentioned, we are seeing greater investment flows into India from countries that are more closely aligned with the U.S. China, on the other hand, is trying to invest more in countries that are more closely aligned with it. So we're going to see a fragmentation of foreign direct investment flows and perhaps other types of financial flows, including equity flows as well, because countries like China and many other rivals of the U.S. are concerned that the sort of sanctions that Russia has been subjected to could be applied to them as well. So I think this geopolitical conflict is going to spill over into the economic dimension, both in terms of trade and finance, which is going to lead to much more fracturing of both trade and finance along geopolitical lines, which may not be great for global stability down the road.
All right. Always an insightful conversation with you. We'll have to leave it there. Eswar Prasad, professor of trade policy over at Cornell University. A closer look here at the incoming presidential administration here in the U.S. and what it could mean for trade and tariffs. Meanwhile, the current administration still in power. Joe Biden speaking right now at the White House about judicial appointments, though he did address the New Year's Eve attacks that we saw in Las Vegas and Louisiana. Joe Biden saying that there is no information that anyone else was involved in that New Orleans attack. Of course, the suspect in that attack is believed to have died in it. At least 14 other people were killed in that, at least 30 injured in it. And the Las Vegas attack, which killed the suspect and injured 7 others. The president also saying he's looking into that and that he has directed his team to accelerate the investigation into both of those attacks. We'll have more on that as soon as we get it. And you can continue to listen to the president's comments by typing Live Go onto your Bloomberg terminal. All right, when we come back, we're going to take a look at shares of Tesla, one of the big movers on the day, and we're going to explain why. Coming up next on The Close on Bloomberg. All right, one of the big reasons why the broader market is down because Tesla is down about 6% here. This after the company's annual car sales fell for the first time in more than a decade. 1.79 million vehicles sold in 2024. Jess Menton joining us right now to talk a little bit more about whether this is an overreaction to this or maybe a harbinger of what's to come.
So actually, Tesla stock, even heading into today, was already had a max drawdown from its all-time high in mid-December of about 16%. So with today's losses, that puts it down more than 20% from that all-time high just a mere few weeks ago. And even if you look at the Mag 7 index, of course, it's been pressured, especially the back half of December coming into the new year. But a lot of that has been driven by Tesla. Of course, just to put in perspective, the first half of last year, it was among some of the worst point decliners in the S&P 500, but it had a massive rebound in the third quarter, obviously as Elon Musk is trying to shift it more towards an AI story and less so, if you think back to sort of obviously in 2017 was more, there weren't as many competitors, right, when it was first launching kind of a cheaper vehicle, but now just not even in the US with Ford and GM, but Europe you have BMW, you have Volkswagen, and obviously BYD in China.
Yeah, and you're also seeing, GM, also one of the worst performing stocks in the S&P, so it definitely is spreading on that. But the other side of it is, hey, fourth quarter was actually up versus estimates, so maybe it's getting better. What's the counter to that?
So actually, in addition to that, because if you're thinking about when it came to renewable batteries, that actually saw a big growth compared with the third quarter. But when you're thinking about what that means moving forward, a lot of people were talking about obviously the policies in the new Trump administration, because you think under Biden that actually helped with when you're thinking about what it came to EV type of regulation. But actually, as Elon's trying to shift it more toward an AI type of company, people are focusing more so if you think about the regulation and what it could benefit if you're thinking about robo-taxis, because of course Elon's has a date of like 2026 for rolling some of that out, but still a lot of skepticism whether or not that could actually happen that early.
Well, but that's what I'm curious about too, though. But a big part of that trade, that 50-60% rally we saw in Tesla over the last few weeks was because of his connection to Trump.
That's
the idea that he spent $270+ million, depending on whose account you want to believe, to basically get Trump elected. He's basically camped out Mar-a-Lago. He's first buddy. Haven't you heard that?
Right.
So isn't in theory he should be benefiting from Trump administration policies when they come in, because he's going to be helping to set those policies.
Right, and to Alex's point, of course, the fourth quarter was strong when it came to deliveries, but it was, of course, the first 3 quarters of this year that overshadowed it.
All right, Jess, super appreciate it. Thanks so much. Bloomberg's Jess Menton joining us there. Coming up, we're 15 minutes away from the close on this first day of 2025. Equities trading a little heavy. This is Bloomberg.
Those broad market conditions are so far away from anything recession or recession risk-like that you can have a pretty significant correction across the board with nothing changing.
And Dennis DeBusschere there, kicking us off to the close just about 50 minutes ago. Our inaugural show, Alex Steele, of 2025. And I don't know if it's going to be a happy ending to it here. I mean, stocks are off the lows of the day. In fact, the Russell now actually pushing into the green. Maybe we'll get a Festivus miracle.
A little confusing price action, wasn't it? And volume wasn't super terrible versus the 10-day moving average. But here's a headline that rings true last year, the year before, and this year. Money market fund assets hitting a record $6.85 trillion at the end of last year.
When did they stop hitting a record, Alex Steele? Because I was told, I feel like well over a year ago, that all this cash on the sideline was going to be coming off, and that was going to boost, stock markets and private markets and all that. When's that cash coming off the sidelines?
What if it doesn't? What if you're just using that as a savings account? And if the Fed doesn't cut as much as we would have thought 6 months ago, do you just keep it there? I mean, you're still going to yield 4%, a little under 4%. Why not keep it there?
Yeah, I mean, you're getting 4.5 right now on a T-bill, and if you shop around, you can maybe make a little bit more than that for what is effectively, I guess, a risk-free, as close to risk-free investment as you can get. All right, let's get the conversation going here, because there is a lot to parse as we head deeper into 2025 as to how exactly you allocate things out. We talk about a stock market that posted phenomenal gains last year, 20+% for the S&P, 30+% for the NASDAQ. Does it keep going? Drew Pettit, he's the director of U.S. equity strategy with Citi. He joins us right now to count us down to the close. And that's kind of the broad question, but I'm just going to narrow it down just a little bit here, Drew, because it's not so much whether these gains can continue. We kind of know what sort of led to those gains in 2024. Are the conditions that we saw in 2024 that sort of helped this rally, are those conditions still going to be intact into 2025?
So I think fundamentally, yes. I think productivity gains are still ahead. I think there's some margin upside from here. I'd say, yeah, fundamentally, story's still pretty good for the S&P 500. The condition that has changed is the sentiment setup. And then on top of that, the valuation or setup is much higher. So, yeah, we have great fundamentals, but at the same time, we got a lot more good news priced in at this point than we did a year ago.
Let's talk about some of the, particular sectors that could benefit. And I want to start with one, because there was an interesting analyst note out earlier this morning by the folks over at KBW involving fintech stocks. Of course, some of them have pretty good rallies. There's some concern about valuations there. But if you're looking at the future, and the future of consumer spending, I would think you would find that in fintech. Is there a bull case for fintech in 2025?
I think so. It's actually one of our top themes again. What's funny, when we think about growth themes and what we've been talking to investors about for the past year, it's been AI, AI, AI over and over and over again. And if you actually look back at the performance of some of the fintech baskets, they've been better than AI, but investors don't want to talk about it yet. Really, we had to work off of a post-pandemic bubble in fintech, but now, once the dust has actually settled for a year, there's a lot of interesting stocks and platforms with really good operating leverage that are still like in this early innings of improvement. So yes, we think, that rally, that trade in fintech is something that can continue.
So I guess the question then is, for this year, do you stick to what got you here? Or do you broaden out to find those kind of undervalued opportunities that aren't all bulled up?
I think you barbell them. So it's funny, like people have been asking us how we'd really position this year. And yes, we do believe in a lot of the structural growth trades. Are we worried about some of the valuations? Yeah, we want to get a little bit more selective there. On the value side, there are still some cheap stocks that are cheap for a reason. I feel like I have to put money in the swear jar if I say cheap at work. But there's a lot of value stocks where you're actually going to see fundamental inflection. So there's going to be catalysts. So for this year, given our valuation and sentiment starting point, we really do like barbelling, let's call it large cap or mega cap growth with some of the mid-value names where we're seeing inflections in fundamentals ahead of us.
Let's talk about froth for a second, Drew, because what made me laugh today is Unity Software. I personally never heard of this company, right? It's up like 8%. And looking around for the why, it's like, oh, it's because, Roaring Kitty talked about Unity, or he talked about a musician who made a song called Unity. Like, I can't even make these dots happen for myself. So, like, what do we learn about the market when stuff like this is still happening?
It's funny. We put this as one of the potential ugly things that could happen in markets. And it's, I guess, the more mentions of Roaring Kitty and the more instances of duct tape bananas being sold for multi-millions of dollars. Honestly, does that drive the S&P 500? No, but to your point on froth, the more frothy we get in any type of risk-taking, the more worrisome the other side is. So yeah, the Roaring Kitty, I can't connect the dots, is that really art types of conversations and those types of assets being priced like that, the more we hear of those stories, the more nervous we get.
Well, what are the stories, though, that do hold up, Drew? So, we were talking a little bit earlier with somebody about, or we're going to talk a little bit later, with someone about travel. And we saw kind of the performance of travel stocks, airlines defying a lot of expectations, hotels, cruise lines as well. And it gets to this broader question about consumer spending and whether it holds up. Maybe it doesn't hold up across the board, but it does look, at least for right now, it is holding up in certain areas, with travel being one of the main points.
Yeah, it's funny. We like global tourism to that point, too. But the other area where it's really holding up, too, is digital leisure. So it's really funny. I either want to go out and have a great differentiated experience, or I want one that's really brought right to me where I want to sit, where I am. So it's funny. Yeah, consumer spending, it is a bit of a mixed bag. You can paint whatever picture you want for the U.S. consumer right now. But honestly, there are secular trends in what sticky spending is. E-commerce taking share, digital leisure, whether that's streaming, online gambling, other types of video games at home. And then the big experiences like global tourism that might play to a different higher end consumer, all could be sticky in the year ahead.
All right, Drew, great stuff. Really appreciate you taking time for us. Drew Pettit, Director of U.S. Equity Strategy over at Citi, helping us count down to the closing bells here on the first trading day of the new year, Alex. And looks like it's going to be a somewhat down day here with most of the major indices in the red, even if they punch into the green over the next 3 minutes here. Not quite the best start, given how phenomenal of a 2024 they had.
No, I know. Two years of, over 20% gains. Mm-hmm. So you could definitely, can we really see that again?
Yeah, well, it's funny. Everyone keeps saying, well, it can happen again. But then I was looking back. It's actually happened quite a few times. Or not,
Also, we probably said that back in 2023.
Yeah, so it has happened before. So it's not unprecedented. But the question is sort of what drives that, right? And we talk about earnings expansion, multiple expansion, obviously the policy risks coming out of Washington, a lot of catalysts that can move this market in either direction.
And I like what Dennis DeBusschere was saying, too, that, you don't want to short big cap tech
Yeah.
Like they may not lead in the same way, but how do you possibly short it? And I think that that's a really good example of the struggle that investors are going to have.
Yeah, there's still continue to be cash machines, and that cash is king in this market as we break down all of the market action on this first trading day of the year right now. And right now we are 2 minutes away from the end of the trading day. I'm Romaine Bostic. I'm here alongside Alex Seal. We're here to take you through the closing bell, and we're going to do it with a global simulcast. We're joined right now in the TV studio. Scarlet Food being wheeled in for the first time of 2025. Carol Massar back in her cage there alongside Tim Stenovic as we welcome our audiences. Happy New Year.
Is the gang back together?
Everyone's back together here in the new year. That's great. Is it going to be woohoo for this market today, Carol?
I don't know. We just had a market guest on that says, looking at, I guess, the first day, trading day of 2025, we're hitting, I guess, a significant low, he pointed out.
Yeah, Vinny Catalano is basically like, nope, we're red for the year now. It's going to be a down year. Not looking good.
It's not a good thing. And he's been talking to folks like Sam Stovall and others. And I don't know, guys. First trading day.
I said, Vinny, you got to look on the bright side.
Yeah. Well, he is right. I mean, this will be the lowest so far this year for the S&P 500.
Hey, I'm wondering if people are still on vacation because volume on the S&P 500 down relative to the last 20 days, Scarlett. But, I think maybe people are getting back to the office.
People are definitely getting back to the office. There's not a whole lot of data to work off of. We had jobless claims this morning, but not a whole lot that'll move markets tomorrow. I'm still hung up on what Romaine was saying. I'm being wheeled in. Carol's in her cage. It sounds like the beginning of a mixed martial arts.
I am not happy, right?
Okay,
I want to run.
but just to be clear, Scarlett can walk just fine. She's not actually wheeled in. Like she's on a chair, and they do wheel her in the chair.
I've never seen her
feel
walk.
like we need to do.
I'm just saying.
We need to sort that out. But what was really interesting, guys, if you take a look at some of the upside here, do you know it's like $15 billion worth in IG supply? I mean, talk about getting after it in the new year. Jeez.
Yeah, a lot of things here that could potentially sort of move these markets as we head into the new year. The first day, not giving you a whole lot here, but remember, this is a holiday shortened week, and we might have to wait just a little bit longer for the real price action, even maybe another 3 weeks until we get that new administration and the new policy proposals start to become reality. More than 300 stocks in the red for the S&P 500, leading to a 0.2% decline on the day. The Dow down more than 150 points, or about 0.4%. The NASDAQ is going to close lower by about 0.2%. And look at the Russell 2000, was in the red for a good portion of the day, squeaking out a gain today of just about 2 points, or about 0.1%.
All right. So could it be that small caps are finally going to outperform? All right. Well, we will have to wait and see. Looking at the S&P 500, though, guys, most names lower today. 327 names in the index, declining 174, Scarlett, to the upside.
And it follows that most sectors are in the red as well, led by consumer discretionary, and that's really Tesla dragging that group lower by 1.25%. Materials and REITs also losing ground by at least 1%. Your best performers are energy names, gaining 1%. Energy only gained 2.3% in 2024, even after a second half rally tied to those AI hopes.
All right, well, I'm going to then kick it off in terms of gainers with some energy names. Constellation Energy, number one gainer in the NASDAQ 100, number two gainer in the S&P 500. Keep in mind that the stock nearly doubled last year on heightened energy needs. It all had to do with artificial intelligence, the demands that were there. You had Microsoft also paying a hefty premium for power from Constellation in particular, and the soon-to-be restarted 3 Mile nuclear island. Well, today, Constellation Energy signing a pair of deals with the U.S. government to provide more than $1 billion worth of electricity and services. So there's a lot going on with this name. So we're going to continue to keep a watch. Finishing the day up about 8.5%, so just off its highs of the session. Then you had Vistra Corporation. This one was up just shy of 9%. So again, just off its highs of the day, really holding on to all of its gains. Keep in mind that this was the first utility to top the S&P 500 in 2024 since 2001. And again, amid the AI boom and the need for energy, the growth of AI and data centers, all of this providing momentum to all of these names. So again, this was the top one in the S&P 500.
Sorry, what was the stat you said? That was the first energy company to be
first utility to top the S&P 500 since 2001.
Oh, wow.
Yeah, so pretty significant, right? All right, and one last name for you, Synaptics. It's just about a $3.2 billion market cap company in the semi space. It's a semi-device company. It rallied after the company said it's collaborating with Google on Edge AI for the Internet of Things. So we're talking about that again. And yet Synaptics up about 8% in today's trade, guys.
All right, you got the gainers, Carol. I got the decliners of the first trading day of the year. I want to start with Tesla, falling more than 6% today. The company did report that annual vehicle sales dropped for the first time in more than a decade. Keith Naughton reminded us the last time they dropped annually, Tesla was selling just a few thousand cars, not more than 1 million cars each year. So this is a very big deal. For the quarter that ended December 31st, it delivered 495,570 vehicles. Analysts wanted to see 512,277. Also in Tesla news today, out there in Las Vegas, the Las Vegas Municipal Police Department saying earlier that Tesla staff are on their way this afternoon to assist in the probe of that blast outside of the Trump International Hotel yesterday in Las Vegas. Also, shares of SoFi are falling today by more than 8%. This after a downgrade from Keefe, Bruyette & Woods, the firm cutting SoFi to underperform from market perform, saying that the company's valuation is, quote, overstretched. Shares trading at about $14 today. The price target, though, set by the firm to $8 implies a decrease of just about 48% from the last close. And Numora Therapeutics, did you guys see this decline today?
Oh, yeah.
It's a $300 million market cap company now, 81% to the downside today, a record plunge. The company's experimental drug for the treatment of major depressive disorder failed to show a benefit in a final stage study. Shares fell more than 81%. I do have an honorable mention, if that's okay. Apple down for a fourth day in a row today. Can't ignore it, down 2.6% today. There was this Reuters report about iPhones being discounted in China as competition intensifies. It's the fourth day in a row that Apple shares have fallen, longest streak since November 4th.
I'm just stuck on that therapeutics chart.
Wild,
talk
isn't
about
it?
gap down. It didn't even look like a chart. It looked like just a line down. All right, guys, I'm taking a look at the bond market. As the equity move was really confusing, so was the bond move. You had a sell-off across the curve, and then you had buying, and then we ended pretty mixed. The 2-year ending flat, and you have a lower yields sort of on the back end. But the standout, though, if you look at the bond market, is the blue chip firm selling $15 billion of debt today. That was quite something.
Well, that's the other thing, too, right? Like, if you need to sell, I mean, wouldn't now, meaning over the next couple of months be the time where you kind of still have this policy uncertainty with the Fed and you could kind of exploit that to get whatever you need out the door?
All right. Well, speaking of rates, let me go to what's going on in the mortgage rate market. We saw U.S. mortgage rates hitting their highest since early July. So we're talking about rates going to about 6.91%, nearing 7%. So it has gotten much more difficult for buyers looking to enter the housing market.
Yeah, I thought
it's not a new story.
I was just going to say that. I was like, is this from the 80s?
Was this shot on like an iPhone 1 or something? What's happening?
I can't answer that question.
Was it? I don't know. Was it?
It might have been.
Amazing.
There you go.
Well, that's when rates were higher back then.
You're talking about the video, right?
Yes,
yeah,
the
I'm
video.
talking about the video, Carol.
Yes, that's amazing.
Sorry, I was focusing
the most important
on
thing.
content.
He's deflecting from the pain of 7% mortgage rates.
I don't want to
That's
hear
what's
that.
happening.
Yeah,
I think I
Stop
saw somebody
talking.
in that video doing that newfangled jogging thing.
Jogging. I hear that's all the rage now.
Yeah, it's this new thing people are
that
doing.
Was a fun, that
they
was
run
a really
for
fun
fun.
thing.
They run for fun.
Wasn't the most fun thing is walking around on January 1st, and you can tell who the first-time runners are.
Yes,
out there on
totally.
Boy, we're digressing. All I'm going to say is, for some, it's getting expensive.
Isn't that what we do on this show?
To maybe buy a home, but maybe we can buy a Birkin. Maybe it's more accessible.
Or maybe not an actual Birkin, maybe Walmart's version of a Birkin. They've been selling these new handbags. They call it a leather purse or a tote shoulder bag, and they range from $60 to just under $300. A lot of people on social media are calling it the Workin.
So what is this I'm looking at? Is that the Birkin or the Walmart version of it?
That's the Workin.
That's the Workin with a W.
That's the Workin. It looks relatively the same.
And this is
and the resale value for this, you guys. I was listening to TikTok. The first time I've ever been on TikTok, and like the resale was like more than double.
Yeah.
Like you can buy it for $40 and like sell it for like multiple hundreds of dollars.
No.
Take that, Birkin.
No.
Does it actually look like a Birkin?
It
Is that what
looks
they
like
look
a Birkin from a distance.
Huh. Okay.
Wait till the lawyers.
You don't need to get on a
That's
waiting
whole-
list.
Yeah, that's what I'm confused. Like, what's going on?
They're just gathering evidence right now.
And Birkins are what, $12,000 to like
Minimum.
$42,000?
Minimum. You're looking at like 10 grand.
That's the thing.
That's if you're one of their favorite people.
Yeah.
So there's a
It's
range.
a sliding
It
scale.
could be like over 100, right? Like hundreds of thousands of dollars, depending on
Hundreds of thousands?
what they're made out of.
Oh yeah,
Yeah,
and there's
that's
this whole
true.
there,
That's
true.
and there
Oh,
was
could be
a, there was a
like
great
snake
book
skin or
written about this too. And like you can't just go in, but you have to like be a current customer and have spent so much
There's a
money
list.
on their
You gotta put your
scarves
name
and other
on
stuff.
it. Yeah,
It's
got to say a
He knows a
special
lot
word.
about this.
Yeah.
I
He's still working on it.
I looked into it once, but now,
do
but
you
now
have?
that there's an $80 or whatever you said version,
$40. You can give her 40.
I mean, I wouldn't know the difference.
They're sold out, though. That's the thing.
That's why the resale market is so good.
Yeah.
Sorry, go ahead.
It sounds like buy them now because they might not be accessible if the lawyers get involved, right? I
The
know.
lawyers are definitely getting
You
involved.
can't get them.
Oh, that's so sad. All right. That's a wrap. Ben, it's been fun to be back with you guys. Happy New Year. Our first trading day of 2025, our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
A lot more coverage coming up here on Bloomberg Television. A big day for the U.S. Congress tomorrow as they prepare to elect a new Speaker of the House. And this is just ahead, of course, the new inauguration of our new president on January 20th. The conversation on what to expect out of Washington. Tobin Marcus, head of U.S. policy and politics at Wolfe Research, joining us next here on The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick here on the first trading day of 2025, and not really reflective of what we saw in 2024. Those phenomenal gains in 2024, and for that matter, 2023, 50% plus gains for the S&P over the 2 years, starting off this third year on the back foot, only down about 0.2%. We're going to talk about one of the big decliners that sort of dragged the broader market down in just a second. But take a look at the Mag 7, because, of course, that was a big part of the story for the trade at the start of 2024, at least for today, not necessarily the big trade for 2025. You did have some bright spots out there, mainly in Bitcoin and in the energy space. But, Scarlett, let's go back to big tech, the Mag 7, and what really was hurting the market today.
Yeah, one of those Mag 7 names, a big decliner today. We're talking about Tesla losing 6% of its value on the day, the worst performer in the S&P 500 after its fourth quarter deliveries missed analyst estimates, resulting in annual vehicle sales falling for the first time in more than a decade. It's not clear how Elon Musk is going to deliver on his projection of 20 to 30% growth of this year, unless it delivers a lower cost EV sometime soon. Even with this recent weakness, though, it's worth pointing out that the stock is up more than 50% since Election Day, since the election of Donald Trump. And we're also looking at Constellation Energy, the best performer in the S&P 500, gaining almost 8.5% on the day. Energy stocks, the best performers overall today, after Constellation signed a pair of energy deals with the U.S. government to provide more than $1 billion of electricity and services, which will then help fund upgrades to its fleet of nuclear plants. So that's a winner on the day. But our top story this hour has to be what happened yesterday. A pair of deadly attacks on New Year's Day, putting the U.S. domestic security issue squarely in focus. According to the FBI, there's no evidence linking a truck driving into crowds in New Orleans with the explosion of a Tesla Cybertruck outside of Donald Trump's hotel in Las Vegas. But the two suspects involved do share commonalities. Both men served in the U.S. Army, and both used the Turo car-sharing app to rent electric vehicles for the separate attacks. And now, authorities are investigating both incidents as terror attacks.
Absolutely. A lot that we don't know here, and it's going to take some time for that investigation to play out. We did hear from President Biden just a little while ago saying that he's asked his team to accelerate a probe into the attacks both in Las Vegas and in New Orleans. Michelle Jamrisko joining us right now, who covers the White House for us here at Bloomberg. So, Michelle, give us an update on kind of what we actually know publicly. I know they're saying there's no connection that they found between these two incidents, but as Scarlett pointed out, there is some overlapping similarities here in what transpired.
Sure, Romaine, a lot of odd similarities. We do have to be careful because there is a lot of speculation. As we heard from the president, one of the big takeaways was that there are probably more questions than answers at this point. He was reiterating what the FBI has told the public at this point. But yes, no connection found yet between those two attacks. New Orleans, they seem more confident, at least, that this was terrorist related. They're still looking into the Las Vegas attack as a potential terrorist activity. But obviously, many questions around what the international implications might be of this. Of course, it is, at this point, as Scarlett mentioned, a domestic investigation. But particularly with the New Orleans driver, there is a paper trail, a social media trail, that he was an ISIS sympathizer. There was an ISIS flag found within the vicinity of the car that was destroyed in the attack. So there are those implications to be looked at as well, and the FBI is calling on the public for all possible leads to look at the backgrounds of these individuals. But certainly a lot of questions about where that connects and a lot of caution about where this might lead.
Right, and the timing of it, of course, on New Year's Day, you still have Joe Biden as the president and his push on foreign policy. He's, of course, much more focused on the U.S. engaging with the rest of the world, and the incoming administration, Donald Trump, favoring a more protectionist, America First approach. What do the two attacks say about the debate that really puts our foreign policy front and center?
Yeah, that's exactly right. And I want to be careful again here because we can't speculate too far about the motives of these two attacks, especially the one in Vegas. But it does bring to mind this open debate and ongoing debate that we've been having about the very starkly different foreign policy visions of Biden and Trump. You saw this morning where Trump took to social media to talk about tying this back to border security, something that he's often done with issues ranging between the economy as well as even hurricane relief and other issues, trying to tie it back to one of his core issues at hand. Of course, he made the false claim that an undocumented immigrant was involved here. That's not to be the case as far as we know so far. So you see that from the Trump side, kind of trying to bring it back to domestic issues, while Biden, of course, would be one to kind of would fall back on a more engagement policy. And as we know, under his administration, the U.S. has been quite involved in Syria and across the Middle East. So one thought that was reiterated by Jane Harman, former lawmaker who's very involved in homeland security issues, earlier today on BTV, she was mentioning that she would not be surprised if there were more copycat attacks, that this could be very much a retaliation from ISIS amid their power vacuum in Syria as the Assad regime has fallen, and just kind of an outspokenness against U.S. policy.
All right, Michelle, really appreciate your providing some much needed context for that. Michelle Jamrisko covering the White House for us in Washington. Let's stick with politics because we want to bring in Tobin Marcus. He is head of U.S. policy and politics at Wolfe Research. And Tobin, I want to steer back to domestic politics in particular because we have the new Congress being sworn in tomorrow, which inevitably leads to questions about who's going to lead the House. Mike Johnson, the current speaker, it's not clear whether he's going to have an easy re-election as speaker, given what we saw transpire at the end of last year when he couldn't get that spending stopgap bill passed cleanly without a couple of tries.
I certainly wouldn't expect him to have a clean re-election as speaker, but I do think that he will end up being the speaker. I don't see a plausible alternative. Trump support will really help him. Trump, by all accounts, is calling holdouts specifically, but I think this really is a situation where plan beats no plan. There's no alternative that anyone who has qualms about Johnson has identified that has any level of credibility.
Well, then that raises the question as to how effective of a speaker he's going to be. We've been here before with these types of speaker fights where the person who ascends to the top is there not because everyone loves him, but because, basically everyone hated everyone else. So how effective is he going to be corralling his party, given how slim that majority is in the House?
Yeah, that's exactly right. He is not going to be dominating this House Republican caucus with an iron fist. I think to the extent that they hold together, it will be because they have really strong political incentives to do so. So when we look at some of the, very kind of high leverage legislative items for markets next year, in particular, this massive tax bill that they're going to try and do later in the year, that's something where the cost of failure is really, really, really high. And I think that Republicans will be very interested in sticking together and getting that done, even though it's going to be really challenging to hammer out a deal. So I think that'll be propelled along by Trump's force of personality, by the pressure he applies, by their incentive in getting something done, rather than by Johnson, really effectively whipping and keeping folks in line.
Mm-hmm. You mentioned tax bill later this year or later in 2025, which invites the question, what will incoming President Trump, focus on first on January 20th? We're expecting a flurry of executive orders, but in terms of priorities, what do you see leading the way and what do you see as secondary?
Yeah, I think the thing that he's going to move fastest and most decisively on, I think, is immigration. I think that's where, it is certainly going to feature prominently in his suite of day one executive orders. He does have some really clear authorities to act there. So that, I think, is the place where we have the most confidence. We'll see decisive moves right away. Tariffs, I think, are probably the biggest debate about, is that something that happens very early on, or is that something that pushes a little bit later into the year? Obviously, we've seen tariff threats from him already, vis-a-vis Canada and Mexico. I think we will see noise. I think we'll see threats. But I think probably it'll take a little bit longer to get the biggest tariff plans in place. I don't think that we're going to see, 10% globally and 60% on China done through an assertion of emergency authorities on day one.
I am curious, Tobin. We've kind of been dancing around a lot of the issues when it comes to kind of the health of our democracy and the future of our democracy. Kind of one of these topics that I think a lot of people just want to stick their head in the sand. We've seen what Trump campaigned on. We've seen Project 2025, and we've heard from members of Congress about certain plans they at least want to put in place, and whether they get them in place or not. I am curious that once we get past the initial, 100 days or whatever, where they are much more focused on some of the more, policy initiatives that are more universally accepted, that when they turn their attention to some of the other things here, will they be able to get those things through? Or is there going to be, any sort of check and balance, whether within Congress itself or within some of the other areas of the government that could maybe blunt the impact of some of those more extreme proposals?
Yeah, so I think, look, Trump will have a lot of power in Washington. He's going to loom very large over D.C. over the course of the next few years. But I do think there's still checks and balances. First and foremost, there is the legal system. I think that we will see a lot of litigation, to the extent that he pushes hard on immigration. A lot of those executive orders will end up in litigation, as they did in his first term. If he goes ahead with the sort of mass deregulatory proposal that the DOJ team has floated, I think that will go straight to litigation. So we'll see how courts come out on some of these questions. And then from a congressional perspective, they have very clear authority to move fiscal items on a party line basis through reconciliation. That's how they're going to address taxes. When it comes to non-fiscal changes, where a lot of the kind of policy changes that are in that sort of democracy space live, unless they abolish a filibuster in the Senate, those are not things they can move on a party line basis. And at least for now, I don't see a willingness from Senate Republicans to change those rules. So I think that there will be, a lot more obstacles to taking, kind of quick, decisive action in some areas than others.
All right, Tobin. Great stuff. Got to leave it there. Tobin Marcus, head of U.S. policy and politics at Wolfe Research. He's going to be a busy guy in 2025. If we continue our coverage here of the political environment, not just here in the U.S., but around the world, and a lot of questions about exactly where Justin Trudeau is right now. The leader of Canada facing mounting pressures to step aside. We're going to talk about what Justin Trudeau wants and, more importantly, what his adversaries expect. That's coming up next here on The Close. This is Bloomberg.
Canadian Prime Minister Justin Trudeau faces mounting pressure to step aside. This as he's largely disappeared from public view since mid-December. Joining us now is Brian Platt, Bloomberg's Canada government reporter. Brian, a lot more lawmakers within the Liberal Party are pushing for him to step aside. But can they actually force him to step aside? Is there any mechanism to do that?
There's not, but over the past 2 weeks especially, more and more of members of his own party, of his caucus, have come forward to say they think it's time for Trudeau to leave and make way for a new leader. It's really rare in Canadian politics for members of your own party to do this. And it really, from everything we can tell, a majority of his party now feels this way. The question in Ottawa at this point is becoming not if Trudeau will resign, but it's when he will and how exactly he'll go about it. He has not been heard from since December 16th, really, in any substantial way. I suspect at this point it'll be sometime next week, but it's kind of a mystery right now. Trudeau has basically kept to himself and seems to be deciding what the best path forward is.
So I am curious, though, too. We talk about this idea of his own party asking him to step aside. We know, of course, the Conservatives would love him to step aside. Is there a sense here that this government, that if this does happen, that the government leadership will transition to the Conservatives away from the Liberals?
when there's when there is an election, at the moment it's very, very likely the Conservatives will win. Of course, if there's a new leader who steps in and if they have time to prepare, it's always possible that can change. At the moment, the Conservatives have a totally commanding lead in the polls. So right now, I think if you're the Liberal Party, you're trying to figure out how quickly can you hold a leadership race, and then how long can you delay an election. We have a parliamentary system, so the opposition parties, if they get the chance, they can force an election. But the government can control the parliamentary calendar. There's various tricks and tactics they can use to delay that vote. It's a really interesting and unpredictable next few months, I think, coming up in Canadian politics.
And very quickly here, who within the Liberal Party, is there anyone that we should watch out for?
Well, of course, the one who brought all this on is the former finance minister, Chrystia Freeland, with her resignation, so watch for her. There's a few other cabinet ministers who may go for it. And another name that's out there, absolutely, is the former Bank of Canada governor and Bank of England governor, Mark Carney.
All right, that's a familiar name to our audience. Brian, really appreciate your joining us. Brian Platt is Bloomberg's Canada government reporter. Trudeau was missing from the public and nothing on his public calendar, but he did go skiing in Western Canada, and there's a couple of social media videos where people were telling him off. Those went viral.
Yeah, I mean, let the guy live. I mean, he's got to ski. It's a holiday. I guess the big question, though, it really gets to this idea of, be careful what you wish for. Everyone always hates the person in charge, but the question is, who are you going to replace him with? And I think this gets to the idea, who's the credible person that's going to take this country forward?
Very good point. All right, coming up, we've got a record year for travel in 2024, but can it continue into 2025? The Points Guy's Clint Henderson will join us next. This is Bloomberg.
"2024 was a record year for travel, pushing airline stocks higher, significantly higher, about 60% last year alone, beating the S&P 500 by the most in a decade. And a lot of folks say that trend, well, it could continue here in 2025. Let's get some insights out of Clint Henderson. He's managing editor at The Points Guy, and he says to expect folks to spend more on travel this year. All right, Clint, I mean, I was looking at the profit numbers, I was looking at the revenue numbers, I was looking at the TSA data, cruise lines, everybody did well if you were involved in travel in some form or another here. And I do sort of wonder what's driving that. Is this all about the consumer demand side of the picture, or is this more about the pricing that these businesses, the pricing power these businesses have?
Well, I think it's both. And I think it's really interesting. We've seen insane levels of leisure travel demand. That's been really noticeable since the pandemic. You now have the return of business travel, so add that onto the fire. And then you see costs escalating dramatically. So all that's adding to sort of the profitability for the airlines, the hotels, the cruise lines. You hit it, but the demand is just really extraordinary. And I really thought personally we'd see a drop off in that leisure demand once sort of that pandemic buildup was extinguished. And we haven't seen that at all. People are traveling longer distances, they're going away for longer, and they're more willing to spend money on travel than they have been in quite some time. So it's really an extraordinary set of circumstances right now.
I am curious, though, when we talk about the demand side of it, and I remember last year, particularly when we got to the summertime, there were a few domestic airlines that kind of said, we're not expecting a great summer for domestic travel. Not bad, but not necessarily as great. And some of that was this idea that they were seeing consumers being a little bit more picky about when they travel, how much they spent. And there was concerns here that international travelers, that those numbers weren't going to hold up.
And that has not turned out to be the case at all. I think a lot of us thought, that we might hit a recession. There might be some drop off in demand. We were looking for signs of weakness. I think the pricing came down a little bit for airfare in particular. But now all I'm seeing is green lights. Like the US dollar is really strong. We've got a new administration that may be a little friendlier towards the airlines. So you're just not seeing that weakness in demand that I expected to see personally. And I think that's a really bullish sign for the space.
And I'm really glad you brought up the strong U.S. dollar. I keep seeing on social media posts that compare the cost of getting a lift ticket in Utah or Colorado versus getting a lift ticket in Austria or Italy, and how, aside from the cost of the flights, it's so much more worthwhile to go overseas to go skiing. And that's just for skiing. I assume that, you can apply that to a beach vacation as well. You're seeing a lot of demand for international travel in a way that perhaps we didn't anticipate heading into the last few years.
Absolutely. And you see airlines like United Airlines adding these really exotic destinations, Mongolia, places that they hadn't flown before, Greenland. And I think the airlines are willing to experiment a little bit with some of these further destinations. We've seen huge demand for Asia, especially Japan, really extraordinary numbers there. So it's fascinating. I think social media is helping drive this a little bit too. You've got, the fear of missing out and people seeing their friends' pictures on Instagram, and they want that selfie in front of the Eiffel Tower too. So I think that's playing into it a bit. And then the US dollar just being so strong, it's a lot cheaper for me to go to Europe to go to Taylor Swift than it is to go to somewhere nearby in the US. It's cheaper a lot of times to fly to Europe for me than it is even to go to the West Coast or Las Vegas.
Especially, Clint, if you use your credit card points. And so I want to get to your wheelhouse here, which is those points and those miles. People have been accumulating them for years. And I guess the thinking was always you got to use them before the companies devalue them. Are you able to still get enough value for them at the moment, or is it a constant race to try to get ahead of the devaluing? What's the latest on that?
Yeah, so it's a constant race. And I think the airlines have gotten much better at pricing the really extraordinary trips in business class. They're more out of reach for most consumers. I think that the levels have been raised substantially. It's easier to earn points and miles now, but you have to be a lot craftier when you redeem them. I'm still able to get extraordinarily high value for my miles and points, but you really have to invest in it and know, because the airlines, the hotels, they've gotten better at pricing those things. So they're out of reach for many consumers, despite the more miles and points being out there in circulation.
So I guess to a question, though, too, because, for a lot of us who have tried to play the game and maybe have gotten exhausted with it, is it better, Clint, to go directly through the venues or the airlines themselves, meaning go directly to, say, a Hilton or an American Airlines? Or is it still better to maybe go through your credit card company's portal or some other third-party travel portal to book your travel?
Increasingly, top-tier elite status is out of reach for individual airlines. Most of us can't get there. Most of us at TPG can't even get there anymore. So I say go for the transferable currencies. You can transfer those to hotels or airlines of your choice rather than being beholden to one airline or one hotel chain. There's programs like American Express Travel Portal where you can get all kinds of deals thrown in if you book hotels through them. So explore that a little bit, because I think it's harder and harder to get that dream trip to Tahiti using your standard airline miles right now.
Oh, I know, Clint. I just booked something the other day and I tried to use my miles and no dice. I had to come out of pocket.
There is, you can still do it. I got business class to Japan on Japan Airlines using American miles, and I got Starlux using Alaska miles. So they are out there. You just have to really dig around and be super flexible.
Yeah, and you have to know what you're looking for as well. Clint, is it worth it for Romain to get insurance for his points? Because that's something that always crops up when you do try to redeem your points. And it's another, anywhere from $18 to $100 that normally I wouldn't do at all, but you kind of think twice if you finally, no? You're shaking your head, no way.
No. Don't do it. So the insurance, if you book with a credit card, a lot of them have insurance, trip insurance on them, and you don't need extra policies in general. If it was like the trip of a lifetime cruise around the world or something, I would splurge on travel insurance, but I think in most cases you don't need it. Just pay with a card that has some kind of protection on it.
All right, Clint Henderson, managing editor at The Points Guy. He does the research so that Romain and I don't have to. Really appreciate it, and good luck to you this year. All right, there was a story about that basically ranked the airlines with the most on-time arrivals.
Yeah.
And I was surprised because none of the ones I thought would show up came up.
Yeah, that's an interesting chart. Aeromexico
they all look so similar.
Was number one at the top with 87% on time. Saudi Arabian Airlines, the U.S. airline that made it towards the top of the list, Delta, which is one that I frequently find myself on. That was in third place overall. That obviously.
So does the anecdotal support that, Romain?
U.S. Yeah, I guess. I'm off the top of my head. I don't think I had too many delays last year with Delta. I did on a couple other airlines that shall remain nameless. But yeah, this is what it's all about, right? At the end of the day, I'll pay whatever you want, but I want to make sure I board on time and land on time, and there's no hassles in between. And some airlines haven't quite figured that out.
Well, a lot of the delays are also tied to their making you check in your bag at the gate as well, even though you are going on board with, your...
Okay, so let me give you, I have a whole laundry list of things that can improve air travel.
Okay.
First of all, the lounge system, we've talked about that.
Yes.
The point system, they need a secondary market for the point system so I can unload mine. And then the bag thing. I literally, where are these people coming from? How did they even get through TSA with these things?
Yeah.
It's like they're carrying like a body in there. And I'm like, how did you even get to the gate?
There's definitely more than one carry-on and one personal
And
item.
then they try to act all confused, like, this won't fit in the overhead bin? No, dude, it's not going to fit in the overhead bin. It's literally like, 15 feet wide.
So it feels like you have to pay for the early boarding no matter what in order to actually get your carry-on into the overhead compartment.
Right, or those people just try to, what do they, line skip? What's the word for it? Where they're supposed to load in like, group 4, but
they snake in at the last minute,
group 1 just so they can get a thing.
I know.
It's a lot. We need bouncers, maybe. That'll help. How'd the market do today, Scarlett?
The market started off the new year with losses. So we did start off initially with gains in both stocks and bonds. That didn't happen in the end, and the S&P 500 logging its 5th straight day of losses, longest losing streak since April. The 10-year yield pretty much stuck around that 4.55, 4.56% range, but emerging markets on the verge of correction. Almost down 10%.
Yeah, this is going to be an interesting story. It'll be interesting to see. Again, as Alex said, first day of trading of the new year, not always reflective of what we get in the days forward.
And cattle futures, I just want to make a quick mention. Wintry weather is coming up, and so cattle futures climbing as much as 1.2% to a record high. That's exacerbating this U.S. beef market that's already very tight on supplies.
Yeah, the weather a big factor there. At least those cows are wearing leather. We'll be back in a moment. This is The Close on Bloomberg.
TV's shrinking world is pitting the big networks against local stations. FCC member Brendan Carr, who's been nominated to lead the FCC under Trump, is pointing the finger at ABC. He's accusing parent company Disney of trying to take more money away from local TV stations. Let's go over now to Los Angeles and speak with Chris Palmeri, Bloomberg News' team leader covering media and entertainment. Chris, a lot of analysts like to compare the media industry to a melting iceberg, the TV industry in particular, and this is something that Disney knows all too well, managing the decline of ABC and its cable networks. So back up a little bit here and tell us what exactly Brendan Carr is accusing ABC of.
Well, this is a particular segment of what's been a huge growth area for cable TV and networks, which is these fees, they're called retransmission fees, that the networks and local stations get from the cable providers, tripled in the last 10 years. But now with everyone canceling cable or satellite TV, that growth is gone. And so now there's a big fight, and the networks, ABC and that, who have paid a lot, for example, for sports rights, want to get a greater share of that money. They used to split it 50-50 with the local stations, your local affiliate in wherever. And now they want maybe more than 50%. And so big fight, not just ABC, but all of the networks, and it's likely to continue in 2025.
But what I found so confusing or confounding, if you will, about this story, Chris, was, this is all being sort of created or exacerbated, if you will, by the idea that few of us are watching the traditional channels, broadcast channels. We're instead going to the streaming services here. So how does this fight solve the problem from their end of it?
They just have to work out deals. In some cases, the local stations maybe will get paid more from streaming services. If you're on Paramount Plus or Peacock, something like that, that's going to be an ongoing issue. But, we're seeing a big fight just in the New York area today where Altice, which operates under the Optimum brand, dropped the MSG cable networks. So if you're a Rangers fan or Knicks fan, you can't watch those games until they work out a deal, if they work out a deal. And in the midst, Altice is saying, hey, go subscribe to this online app, Gotham app, and watch it there.
Yeah, and I guess that's what it comes down to. The streaming services competing with cable networks and especially those regional sports networks. Let's talk about one of the streaming services, Netflix, because Squid Game 2 premiered the day after Christmas to a lot of hype. It got the initial numbers, some pretty impressive numbers, but the critics gave it a mixed review. Does that matter in the end?
It doesn't seem to have mattered this time because it's 68 million views in the first few days, which was the greatest ever premiere for a Netflix show. So it's working from that standpoint. We'll see. Sometimes these things can burn out. Netflix releases everything at once, and maybe all the super fans just watch, and then it doesn't have the legs that some other programs weigh. But they've already said they're making a new season this year, so that'll be the third and final one.
All right. So, Chris, kind of wrap this up because we talk about this idea of what Netflix has done, and they've done a good job with it, obviously, not just in terms of the content, but even pivoting its business model here. When we talk about the amount of content, I saw an interesting stat saying Netflix is probably one of the more aggressive of the streaming services in terms of canceling programs. Does that not hurt them at all? I mean, do people sort of wake up, realize their favorite program is not coming back, and then cancel the service? Or is Netflix and the other streamers, for that matter, kind of immune to that type of reaction?
No, I mean, people feel it. We had a story last week about a show called Arcane. It was based on a video game, and it did very well. People loved it, even won Emmys, but Netflix canceled it. It was just too expensive to make, and so this is going to happen. Netflix, ironically, is looking a lot like the old TV in terms of misses and moving into sports, which is more costly, and so. This is going to be the way things are.
Yeah. All right, Chris. Great stuff as always. Chris Palmeri, who helps lead our coverage of the media and entertainment industry as we continue on that topic. Coming off an interesting year for Hollywood box office was, slightly down from last year, but they still generated more than $8 billion at the box office domestically. Sean McNulty is the creator and writer of the Wake Up newsletter over at The Ankler, here to talk about what we saw in 2024. And I do want to start off here. We had a great story, and there was also a great story in the New York Times, too, I should point out, about the lack of creativity coming out of Hollywood. You look at the big blockbusters this year, the top 5 movies, Inside Out 2, Deadpool and Wolverine, Despicable Me 4, Moana 2, and Dune Part 2. What do they all have in common? They're all sequels. Nothing new about any of these films. Fine films, I'm sure, Sean, but are we ever going to get back to a day and age where we get more original content out of Hollywood?
I was just actually discussing this morning with a few colleagues. The first quarter this year, yes, you're going to get a lot more of this. And we're going to see what the response is. There's the new Captain America film from Marvel, and the new Snow White film from Disney. But outside of that, in the first quarter, there's a lot of original films coming, no existing IP. So you're going to have a little bit of that. We'll see what the results are. In the top 10 of the year for 2025, I don't think you're going to see too much of a variation. You have new Mission Impossible film coming out. You've got, Return of Superman next summer, things along those lines. It's what Hollywood has always done, though. I don't know that the moviegoer complains about this. It is true, but they come back out to see it. They're making, these movies are making billions of dollars in revenue, so It is what it is.
Well, yeah, and obviously there's a reason why Hollywood does this, because this is where they make money. But I mean, there used to be a different time and place where you had more of a mix. You still had the big blockbusters that were going to generate most of the profits for the studios, but they were still bankrolling more, I guess, artsy, if you will, for lack of a better term, films. Is there any real incentive for the big Hollywood studios to continue backing those kind of second-tier films if the Captain America sequel and the Despicable Me sequels are what's going to generate the lion's share of their profits?
I think they're coming back around to this. I also track in my newsletter every day the new deals, the new scripts. The spec script market has made a big comeback in the second half of this year. But look at movies like It Ends With Us. I mean, that movie did $350 million worldwide on a $25 million budget. Anyone But You also did over $200 million on a $25 million budget. So the audience is coming back for these films. They're very, very small test cases, but the early results here that they're seeing are positive. And these are the films they're now putting into development to make more of these kinds of, we could call, doubles or triples, not the home runs or grand slams that are the billion-dollar movies. So I have confidence this will come back. I know the 2024 lineup does not necessarily give you that kind of confidence, but I think we will see the calendar start to fill out around those tentpoles. The tentpoles will still be the main, the business here, but it will start to grow.
So, of course, the movie slate has been set, months, if not years in advance. I want to get a sense from you, Sean, what the mood is like in LA, because there's a lot of anticipation, excitement from the studio executives and the heads of these big media companies, like a David Zaslav, for instance, because of the new change in administration and the opportunities that will create. But we've seen a lot of jobs disappear ever since the strikes of a few years ago. And this idea of a lot of deal making means there's going to be consolidation and more lost jobs as well. So even as there's excitement among the upper echelon, what does it feel like for people on the ground who have a lot of these jobs that feel like they're getting scarcer and scarcer?
Yeah, there's two big things on the horizon in 2025. Obviously, the Paramount Skydance deal should close. Most people are thinking somewhere in the first quarter. They've promised $1.5 billion of cost savings, which translation is probably going to be more job cuts at Paramount Global to come. We'll see what the new administration there has in mind. WBD is also signaling they're open for business. They have mentioned a top-line reorg at their company. Again, these are kind of code words for probably some downsizing, probably some staff trimming. So on the corporate side, you have that. On the other side, though, the bigger thing around town in LA is really the exodus of production overseas and to places just outside of Los Angeles. I mean, this has not come back very strong post-COVID, and this has gone to other countries. You have a 40% tax credit over in the UK, which the California just cannot compete with. And you have all these people who live in town and these sound stages and people who are just not working as much. So that is probably the bigger concern is, will this production ever come back? And if not, what does that mean for the town of Los Angeles, who employs tens of thousands of people in this business who rely on that local production? So that's a bigger question, I think, for more people in Los Angeles and Hollywood.
All right. Sean, thank you so much. Sean McNulty is creator and writer of the Wake Up newsletter for The Ankler.
So I was looking through, Scarlett, sort of the big movies that are on the slate for 2025. Yeah. It's a lot more sequels and remakes. The Wolf Man, which is just kind of an updated version of The Wolf Man that we saw way back in the day. Did you know there's going to be a new Bridget Jones?
Yes, I heard about that. I remember she was filming that.
Mad About the Boy. That's
is Hugh Grant in it? Or is Colin Firth in it?
I don't know. The Monkey. Here's one, Ephes, which I think is sort of a new movie, not like based on existing intellectual property.
Is it for kids or is it for adults?
It has something to do with baseball. Don't ask me what these movies are about.
Clearly adults.
I haven't done a whole lot of research on this, but it gets to this idea, though, of sort of what Hollywood is feeding us. And they just assume that we just want to see the next iteration of, superhero, the next iteration of whatever hit animated movie or something else. And I get it, but I don't know, some of us do want to see something maybe a little more new and fresh.
We want to be delighted.
And creative, and surprised.
I know. Well.
Is that over?
Yeah. I mean, they've always gone for the easy wins, which is cautious optimism and let's work on existing IP. Let's work on things that have, a name and a place in your memory.
What was the last movie you saw in the theater?
I feel like
exactly.
Napoleon, which was terrible.
You saw that in the theater?
I know.
Oh, wow. So you were the one.
My kids were really excited to watch it. We went there and I was kind of like, this is dragging on. It's a little bit,
Who was that? That was Joaquin Phoenix?
Joaquin Phoenix, yeah.
Interesting. Okay. All right. I'll probably never see that. But still ahead, we're going to set you up for what to watch over the next 24 hours. Stick with us. This is Bloomberg. All right, here's what markets will have their eyes on over the next 24 hours. We start at 10 a.m. Eastern time, the ISM manufacturing data.
And it's expected to show another month of contraction. We're expected to slow down to 48.2 from 48.4. Anything below 50, contraction.
And of course, it's been in contraction since at least late 2022. At 11 a.m., we're actually going to hear from one of the key Fed speakers. Who was that? Tom Barkin.
Tom Barkin, yeah. Richmond Fed president. He's a voting member of the FOMC, and there's going to be a lot more Fed speakage in the next couple of days.
But probably the highlight of tomorrow, or maybe potentially low light, is the U.S. House of Representatives is expected to elect a new Speaker of the House. The question, Scarlett, will it be the old Speaker of the House, Mike Johnson?
I don't know. Well, we know Donald Trump has given him his endorsement, but that may not mean very much. Last time, 2 years ago, it took 15 rounds to elect Kevin McCarthy.
Yeah, it'll be interesting to see whether we see a replay of that, and more importantly, if not Mike Johnson, who?
I know. Anyone raising their hand?
Scarlett just raised her hand. Hopefully she'll be here tomorrow, or she'll be down in Washington. We'll have full coverage, of course, of everything going on in the markets right here on Bloomberg.